Why did the government bail out AIG? Imagine a giant domino falling and knocking over everything in its path. That's what was happening during the financial crisis of 2008. One of the biggest pieces in that domino was the American International Group, or AIG. When the housing bubble burst, AIG's massive insurance contracts linked to risky mortgage-backed securities started causing huge losses. These contracts, called credit default swaps, were like insurance policies on complex financial products. When the real estate market collapsed, AIG faced over $30 billion in losses from these contracts alone. They couldn't pay the demands for more collateral, which are like security deposits to cover potential losses. This created a liquidity crisis, similar to a bank run, where the company couldn't meet its obligations. AIG had also made big bets on real estate securities without enough safeguards or reserves. Instead of saving profits for tough times, they used the money to pay executives and shareholders. When the crisis hit, their credit rating dropped sharply in September 2008. That meant they had to put up even more collateral, which they couldn't afford. The company was on the brink of bankruptcy, and if it failed, it could have caused a chain reaction across the entire financial system. The government stepped in because AIG was so large and connected to so many other financial institutions that its failure would have worsened the crisis. The Federal Reserve Bank of New York provided an emergency loan of $85 billion. Over time, this support grew to about $182 billion. The government took a majority stake in AIG, meaning they owned most of the company until it could recover. This move was meant to protect taxpayers and stabilize the markets. Looking at this from history, AIG's rescue shows how risky it can be when big financial firms don't manage risks well. It also highlights how a single failure can threaten the entire economy. The bailout sparked debates about moral hazard, whether rescuing failing companies encourages risky behavior. It led to calls for stronger rules to prevent such crises in the future. In the end, the bailout allowed AIG to sell off assets and restructure. Over the following years, they paid back the government, even making a profit. This event remains a key example of how governments can step in during major economic disruptions to prevent total collapse.